For more on the Fed's decision, let's bring in Greg Daco, EY chief economist. Also with us is Bob Elliott, co-founder and CEO of Unlimited. So, Greg, let me start with you. Just give me your take on the news. Is it what you expected?
Yeah, largely what we expected. The Fed is on hold. We think the Fed is likely to remain on hold for the foreseeable future, and the next rate move will likely be a cut, but not before the middle of 2024. I think one of the key elements in the statement is the fact that they noted that tighter financial conditions are also going to weigh on economic activity and eventually on inflation. That aligns with this narrative that some of the tightening in financial conditions is doing some of the Fed's job in maintaining this tight monetary policy stance. So we'll hear more from Fed Chair Powell as to forward guidance going into the end of the year. They'll want to maintain that optionality of potentially further tightening down the road if needed. But for now, the Fed is on hold.
Hey, Bob, it's Julie here. So how much tightening have we seen, right? Even though some of the effects are not really on the surface, has the Fed done enough?
Well, I think the main question is take a look at what's happening with economic conditions. And I think what's really important, what we saw in this statement was an emphasis of the word strong growth. And so if you were just looking at the economic outcomes, we had 8% nominal GDP growth in the third quarter. We have 5% real growth. We have wages growing in the most recent ECI report of about 5% nominal. These are all indicators of very strong economic activity. And yet, what it looks like is the Fed is more focused on the possibility of a forward-looking, financial-oriented tightening than they are looking at the data that's in front of them. Because if they were just looking at the data in front of them, the decision would be relatively clear, and that would be to tighten interest rates, given just how strong the economy is and how low unemployment is in the economy right now. But they're focused on the financial conditions, and in the same way in which they were very cautious coming out of SVB, they continue to be very cautious anytime there's even a modest financial hiccup in the system. All things considered, 10% on stocks and 100 basis points on bonds aren't that big a deal in the context of the overall economy.
And Greg, let me get your take on this question of lags. I've talked a lot about it with Julie and the guests, and this time difference between when you hike the rates, Greg, and its actual impact on the economy. And there's great debate about that, short or long. How do you think about that dynamic, Greg? Are we just at the start of seeing the effects of this rate hiking campaign?
Well, I think, we're in an environment where there's no doubt the economy remains robust. If you compare the economy across the world, the U.S. economy remains the one that looks the best. We did see strong growth over the summer. We did see consumer spending. We do have an environment where there is still that inflationary pressure. But if you look ahead, and I think that needs to be the Fed's key focus going forward, is if you look ahead at the expectations for the labor market, we're seeing a slowdown and moderation in job growth. We're going to see more easing in inflationary dynamics, moving back below, I would think, the Fed's own expectations for both headline and core PCE going into the end of this year. And we are going to see a slowdown that is disinflationary. I think these are really the conditions that the Fed should focus on when it guides monetary policy going into next year. It's not so much about the backward-looking, data-dependent approach as much as it is about a forward-looking approach that incorporates likely developments on the economic front as well as financial market developments.
And Greg, you've been pretty outspoken on this, that the Fed is too backward looking here. I mean, to sort of take the other side of that, and something we've heard from some economists, does 25 basis points more matter that much one way or the other?
Well, I think you can frame that question in the right way, because when you say, does it matter one way or the other, not in the immediate future, but it does have an effect on financial conditions. So if the Fed were to surprise markets with additional tightening or less tightening relative to its expectations, that could have big consequences in terms of the financial market implications, long-term yields, equity prices, volatility, that would then affect business decisions. I think what's key here is that the Fed had a playbook in the first half of the game. They were behind in terms of inflation. They tightened very aggressively, almost at all cost. Now the game is very different. We're seeing balanced risks of over-tightening and under-tightening, and that requires a more nimble approach in terms of policy making. factoring the possibility that there could still be a fumble and that we want to aim for soft landing. So not tightening too much is the right decision at this time. And it's really about watching where the economy is headed and whether and how resilient the economy is going to be and how inflationary the growth prospects are actually going to be.
And Bob, so now all attention, of course, today, it turns to Jerome Powell and that presser. What are you going to be listening for there?
I think the main question continues to be, what is the reaction function? And I think that ambiguity about the reaction function has been the challenge that most have had in the markets, over the course of the last really year or so. What it looks like, based upon the statement, is that the emphasis is going to be around those financial market risks, much more so than the risks that every day that inflation remains elevated, there's an increasing risk that it becomes entrenched. And to be clear, that's very normal. Early in a longer term inflationary cycle, most central bankers are typically quite hesitant to meaningfully tighten in the face of inflation, of elevated inflation pressures, because the risks of tightening too much are relatively known and concerning, and the risk of not tightening enough are basically things that play out for an extended period of time. But odds are, if the Fed continues to take this extremely cautious path, and inflation continues to be elevated over time, and we continue to have it seep in and get more entrenched in the economy, the bigger mistake the Fed will be thought of as making during this period is not getting started too late, but it's going to be much more about the fact that they stopped hiking too early. And that's the real risk for the Fed, that they'll have to do a whole heck of a lot more a year from now, let's say, because they've been too hesitant today because they're concerned about financial risks.
Bob, I gotta tell you, it feels like you're in the minority here, given, at least compared with most of the folks we talk to, right? Most of the people we talk to warn more of a policy mistake here from over-tightening. Breaking something in the system is something we've heard from the likes of Mohamed El-Erian and others. I think Greg is probably somewhat on the same page here, that we saw a little hint of it, right, with the regional banking crisis, but it didn't blossom into something more. Aren't you worried about that kind of a risk as well?
I think the question from the Fed's perspective, which is what they're trying to do, what their mandate is to preserve the highest quality medium-term growth by balancing both employment and price stability. And when it comes to the thing that determines medium-term growth is productivity, and the thing that determines productivity is price stability more than pretty much anything. And so I think there are a lot of people out here talking based upon their life experience of a secular disinflationary environment where we're being responsive to growth was the prudent strategy because there was no cost to not being responsive to inflationary pressures. They didn't have to worry about inflation. But we're in a different environment. The world of 40 years of secular disinflation is over. We're moving in the opposite direction. And what we're seeing is across both the Treasury and the Fed, a set of dovish responses that, if continued, will put us on a path to a longer-term, higher inflationary environment. And so it's true, we've got to call up experiences like that of the 60s, where we had expansionary deficits and monetary policy that was too easy, that set the stage for the inflationary 70s. Those are the experiences that are most pertinent, not people's experiences and views drawn from decades of disinflation and peace.
Greg, what do you think?
I think that's absolutely right. We are in a very different landscape when it comes to inflationary dynamics. That being said, we're also in an environment where monetary policy is currently quite restrictive. That is implying downward pressure in terms of economic activity, and it's leading to more disinflation, actually more disinflation than the Fed had expected. If we look just at the September economic projections, the Fed has core inflation ending the year around 3.7%, headline inflation around 3.3%. It looks like the forecast, the actual data, will come in below that, likely around 3.2%, and probably around 3.5% for core inflation. So we're looking at a forecast in terms of economic data that will be forthcoming that's likely to undershoot the Fed's own inflation expectations. So yes, there are structural forces that will likely put upward pressure on inflation over the medium term. But I think if you look at the next 12 months, we're in an environment where tight monetary policy is having the desired effect on economic activity and on inflation, and we're moving in the right direction, so that further monetary policy at this point, tightening is not necessary, and we need to really be in this holding pattern focused on the effects of this tightening on economic activity with a lag, as well as on financial conditions.
We got a little debate going here. Bob, lastly, just very quickly here for investors, for the next 6 months, what is the most important thing strategically that investors should keep in mind?
Well, I think, frankly, the biggest thing that they should keep in mind is looking towards balance, more balance in terms of their portfolio. The typical 60-40 portfolio is all in on disinflation and strong growth. That may occur, but there are a lot of circumstances. If you look across markets, basically markets are priced in all in on a soft landing environment occurring, and there's lots of different ways in which that won't occur, whether inflation ends up being a little more elevated and that benefits diversified commodities, whether growth ends up being slower than expected, which benefits bonds at the expense of stocks, or whether, frankly, there's increased conflict relative to people's expectations, which could particularly benefit gold. And so I think in a lot of ways, the traditional 60-40 positioning here is one of the lowest probability portfolios that are out there. And so most folks have to look for other assets and other positions that are going to put them into a situation where they can absorb a wider range of outcomes than currently priced in.
Greg Daco and Bob Elliott, thank you both guys so much for joining us today.